welcome to this briefing on the Irish Fiscal Advisory Council's November 2022 Fiscal Assessment Report, A Budget in the Time of Inflation. The Fiscal Council is Ireland's official independent budgetary watchdog. The key messages of this report are that Ireland's economic growth has slowed considerably and is expected to remain weak over the courses ahead. Inflation is set to remain high into next year, and uncertainty is also very high about prospects in the global economy and domestic pressures. The government forecasts a deficit of around 3% of national income for this year, excluding excess corporation tax receipts. This is a substantial improvement on last year, and that's been driven by strong tax receipts and the ending of pandemic-related spending. Contingencies have been used to pay for Ukrainian refugees and cost of living supports. Budget 2023 introduced a large package of around 11 billion of measures for the coming year. Of those, there are around 7 billion in permanent measures, 5.8 billion on spending, 1.1 billion on tax, and there's around another 4 billion in temporary measures aimed at addressing the rise in the cost of living. In the Council's assessment, this strikes an appropriate balance between protecting vulnerable households and avoiding higher inflation. The temporary deviation from the spending rule to allow a 6.8% increase in core spending is sensible. However, this amount of spending does not compensate for inflation in full, but of course a large package of temporary supports is also there to help. Under the 5% spending rule, in the medium term from 2024, we would expect there to be an underlying budget surplus, and the debt ratio would be on a downward path. However, this amount would be insufficient to stand still in terms of the current levels of public services and taxes, given aging pressures that we face, so some hard choices are going to have to be made. In that context, the government needs to improve planning for the long term. We know that meeting climate change objectives is likely to have very large fiscal costs. The government decision in September not to raise the pension age will add to the future tax burden, and reliance on unpredictable corporation tax receipts needs to be reduced over time. Fiscal framework should be strengthened. Forecasts should always be made at least 5 years ahead. The 5% spending rule, which is a welcome improvement, should be reinforced to recognise the impact of tax measures, capture the full range of government spending, and link it to debt targets. At the same time, multi-year expenditure plans at the departmental level would support this process and should be published as required with the budget. The recommendations of the Tax and Welfare Commission, which are very helpful, should also be quantified to help set out the long-term options. The restoration of the National Reserve Fund is welcome to avoid further increasing our reliance on excess corporation tax receipts. However, the fund needs to be better designed and refocused on saving for future pension costs. I'll now go through the reasoning behind our key conclusions. One theme that runs across the report is that the 3-year forecast horizon used in Budget 2023 is too short. This is actually shorter than has been the norm over the past decade and goes against commitments from the government to extend the forecast horizon. In practical terms, what this means is it's very difficult to understand what the government really thinks about the economy, given that we have this large shock that's going to take a couple of years to work through. We can't really see what they think about the medium term. And on the fiscal side, this short forecast horizon means we can't really see the impact of aging and climate change, which are very important for people to understand the trajectory of the public finances. Forecasts should always be made at least 5 years ahead. Turning now to the economic outlook, inflation is still running at a very high level. So the chart on the left shows the inflation that we've seen so far has been primarily driven by energy and food prices increasing. But if you look at that green area on the left and we zoom in on that on the right-hand chart, domestic inflation, which we're measuring by the inflation of goods that have a low import content, has also picked up very substantially. It's been rising around 6% compared to around 3% since the pandemic. So while the international factors are there, we also see that there's a strong element of domestic inflation. Now, this high inflation has stunted the recovery. If we look at the left-hand chart, which is a chart of modified domestic demand, we can see that in value terms, this has continued to increase and is expected to continue to increase. But because of higher prices, the volume associated with that, the amount of goods and services that's actually being provided, the growth there has slowed considerably and it's expected to be pretty flat over the coming quarters. The economy is not expected to expand in terms of the volume of domestic demand. Of course, internationally, as well as the price factors, we know that high uncertainty and tighter financial conditions are slowing demand, and of course that will impact Ireland as well. Focusing in on consumption, we see a similar pattern. So the red line is the volume of consumption from the budget forecast. We see the consumption is forecast to slow. It's expected to be pretty flat over the coming quarters, and then to recover, but to a lower level than was originally anticipated, reflecting higher energy prices. But one thing that's important to understand is there is a very big puzzle here in terms of what the starting position of consumption is in Ireland. As we explore in this new analytical note that's being published today by Kevin Timoney, that there's a tension between the official numbers that we see for consumption published in the national accounts and a range of other indicators, including retail sales, including other indicators of the savings rate, including cards data, all of which suggest that consumption has actually been much stronger in Ireland than the official data are currently reporting. One example of that you can see in the right-hand chart. The yellow line shows the savings rate in the euro area. You can see that increased with the pandemic. Essentially, the euro seems to come back to the same level as it was before. If you look at the Irish data, it suggests there's been a massive increase in savings to a really exceptionally high level, and that it's stayed at that level. So I think this does raise a big question about where we are in terms of consumption. At the same time, the labour market has remained pretty tight, but it is projected to weaken. You can see that unemployment is at historical lows. It's likely to come up a little bit from that. We see that hiring has slowed, but overall, the labour market still does remain very tight. What's probably more relevant to most workers is what's in the right-hand chart, and this shows real wages per hour. And we can see that real wages are expected to fall significantly because the nominal pay increases that people are getting have not been enough to compensate for higher inflation, and this takes real wages back essentially to its pre-pandemic level. Over the medium term, the good news is that growth is forecast to recover, partly because energy prices will fall and partly as the economy adjusts. We can see that growth path in the left-hand chart, but output is expected to remain at a permanently lower level than would have otherwise been the case due to higher energy costs. And in terms of household disposable income, this is expected to fall by close to 5% during the 2 years, 22-23, during this period of high inflation. So people are going to be experiencing significant fall in living standards on average. Of course, there are many risks around this forecast, primarily to the downside in terms of activity. There are still risks around energy supply in Europe, both this winter and next. The situation in Ukraine could also, in a number of ways, impact the global, European, and Irish economies. Domestic price pressures could be stronger than expected, that would lead to a loss of competitiveness. And if that happened at the European level, higher interest rates. And there's a lot of uncertainty about the housing market and the digital sector. The right-hand chart shows how much the IMF has revised down its forecasts of the global economy over the past year. And I think that's a measure of how uncertain things have been and how negative various developments have been. Turning now to the budgetary outlook. The budget 2023 introduced a new measure of the public finances. That's the budget balance excluding an estimate of excess corporation tax receipts. So this removes the past corporation tax that can't be explained by the growth of the domestic economy since 2014. That amounts to around 9 billion euros this year. So if you look at that chart, what it means is, well, the budget balance overall actually is expected to be in surplus this year and build up to quite a sizable surplus. If you look at this underlying measure, if you take out the excess corporation tax, you see that there's actually a deficit this year of around 3%, and that narrows a bit next year, and we only move into surplus in the medium term. The introduction of this measure is welcome. I think it provides a much better picture of the public finances, and it should be more widely applied, for example, in the monthly exchequer returns. And one of the advantages of this measure is it's not going to be pushed around by variation in corporation tax receipts, whether that's a big acceleration or whether that's a shortfall. So this is a much more stable measure in principle, much more useful for public finances. On that basis, the government's forecasting a deficit of 3.1% of GNI star this year. Now that's been helped by income tax and VAT receipts that have grown very strongly. On the left-hand side, you can see the strength of those post-pandemic recoveries and how in both cases we're above the pre-pandemic trends. It's also benefited from some winding down of the pandemic supports, but the government has done quite a lot of temporary spending this year, both for COVID at the beginning of the year, but also for refugees, particularly the cost of living measures, and more recently the concrete blocks redress scheme. Also in the final months of the year, we're seeing the impact of increases in public sector pay. Looking ahead to 2023, Budget 2023 sets out an unusually large package of measures. This amounted to some 11 billion euros. Of that, 6.9 billion in permanent measures, 5.8 billion on spending, 1.1 billion on tax, and around another 4 billion of temporary measures. If we just focus on that permanent core spending, this shows how those plans have been revised up for 2023. You can see the blue bars show how the starting level of core spending has been revised up in 2022. That's basically associated with the public sector pay deal. But then you also see how these green bars, that's the increase in current spending, was basically revised up in July in the summer economic statement. That's when the government said that it wasn't going to meet the 5% spending rule. It was going to have a temporary deviation. That's really what pushed up spending relative to original plans. So you see it's not enormous revisions compared to what was anticipated, say, in April. Looking again at those permanent measures, we can see that those were mostly aimed at the cost of living and public sector pay. So this chart breaks it up by different departmental areas. You can see the really big areas of increase are in social protection and in health. And those green bars, what we call new resources, are mostly going to help pay for higher welfare payments, higher pensions, and public sector pay. These measures are very large in cash terms. It's of course important to remember that they don't fully compensate for higher inflation over this period. Temporary measures also play an important role in this budget. Temporary measures are actually a bit less than they are in 2022, and that's a bit less than they were in 2021. It's very sensible to use temporary measures to smooth the economic adjustment, and given the economic uncertainty, like we don't know how long energy prices are going to stay this high, around a third of these measures in our assessment were targeted. On the spending side, we also see that public investment has been revised down. You can see that in the left-hand chart where the dark bar is what we had in the budget. Of course, public investment is also facing a squeeze from the fact of higher construction prices. This means that either less is going to be delivered, or there may be pressure in years ahead to increase spending to deliver the same volume. That means if you look at the second chart, that the share of national income devoted to investment is now somewhat lower than was originally planned, but it's still very high by historical standards, and it's one of the things that's supporting the economy during this difficult period. However, it would be helpful for planning to be improved, particularly outside the exchequers and in local government and around housing. There's very little transparency in the budget documentation about this, and we don't know very much about what's going on, but it explains a lot of these frequent revisions that you see on the left. Turning to the tax side, corporation tax this year is now going to be the second largest tax head, overtaking VAT. The chart on the left just shows how spectacular that pickup has been in 21-22 so far. But these receipts are very unpredictable, both in the short and the long term. A very large share is accounted actually by probably 4 or 5 multinational firms. And there are many firm-specific factors affecting them, very hard to predict. These receipts, of course, also rely heavily on the digital sector, and there is the potential impact of tax policy changes. Exactly how these happen and what their impact is again very uncertain. So there's very high uncertainty on what's now become really a very, very major part of our tax base. Looking ahead, and if the government continues to follow the 5% spending rule, we expect there will be an underlying surplus of 1 to 2% in the years ahead. So you see that we have had this recovery even in the underlying position, and we end up somewhere with a small surplus. But meeting the 5% spending rule, as the government is planning to do, will require some choices. If we look at the left-hand bar, the gold dots that you see, the amount that the government has allocated consistent with the spending rule for spending. However, the size of those bars tells you how much the government would need to stand still. That is how much it would need to increase pensions, welfare payments and pay, and other costs to keep track with inflation over this period. And you can see there's a bit of a gap between the two. It's around 800 million a year on average. And it's coming from the fact that the higher aging costs, those dark bars you see at the bottom, are putting additional pressure on this public finances. This means that choices are going to have to be made between different spending priorities and potentially raising taxes if the government is to meet this 5% spending rule. And it would be helpful if the government had longer term budget projections that really show how this is going to be achieved. Overall, as a result of essentially this improvement in the public finances, we see that debt, and with the government planning to maintain it, stay on the path of its 5% spending rule, debt is expected to fall. We see there's another downward revision in the debt ratio, and in the short term, we're protected by relatively modest financing needs. Turning to the Council's assessment of Budget 2023, we think the Budget 2023 struck an appropriate balance between supporting households and avoiding adding to inflation. The chart on the left focuses on the core increase in spending, and while you can see those bars are quite high, they're actually falling somewhere between those red dashes that are what would have been consistent with strictly following the 5% path, and those sort of purple dashes or burgundy dashes at the top, which is what would have happened if the government had fully uprated spending in line with inflation. So the government is kind of striking a balance, reaching a compromise between these two different considerations over the 2 years. Looking at the right-hand chart, you can see that this is kind of what the government's been using as a mixture of permanent and temporary measures to protect households. Now, this chart, which is based on excellent analysis by the ESRI, shows how people's disposable incomes at different points of income distribution are changing between 23 and 2022. Now, what you see from the negative blue bars is because the government didn't fully compensate people in terms of higher welfare payments and the like. You can see their real incomes would have fallen a bit, but the temporary measures, in the short run at least, are protecting people. And actually everyone's, in fact, we don't really see falls in real disposable income in 2023. There are, of course, some in 2022 that weren't compensated fully by what was planned and what happened, but this shows how the government is mixing permanent and temporary measures to provide a reasonable amount of protection to households. Of course, there is a trade-off here, and there are inflationary pressures as a result of the government's policies. What we've done here is based on some modelling work using the Council's MAC model. This is what we expect the additional inflation coming from the government's measures is compared to with what would happen if they'd done nothing. This shows there is some inflationary pressure, but obviously in the scheme of the kind of inflationary rates we've seen in the past over the past year, this is relatively, within reasonable bounds. And if we look at the sort of path of core spending in the public finances, and this is what really matters for fiscal sustainability, the deviation that we see is relatively small. On the left-hand side, we see something called net policy spending. We see that dark line of what the government is planning to do is actually reasonably close to a path where if they just increased it by 5% since 2019, according to the spending rule. So they were a little bit below, now they're a little bit above, but it's pretty much on track. And it's much lower than if the government had taken an alternative path of trying to compensate more aggressively for higher inflation. Looking at the right-hand side, where we see the change in permanent net policy spending. In cash terms, that's the height of those bars. You see the package is quite big, but actually in real terms, the real increase in real net policy spending over 2022 and 23 is close to zero. Looking a little bit more generally at the public finances, public debt still does remain a concern. Ireland has relatively high public debt. And though we do face all these very pressing short-term challenges, it's actually very important that we use a window that there is for Ireland to get debt down to a safer level. Reducing the debt ratio over the coming years while interest rates are low and while corporation tax receipts coming in very strongly will leave the public finances in a safer position in a few years' time where we're more likely to be hit by shocks. So the left-hand chart shows a scenario where interest rates would rise fairly significantly. Now you see that in the short run, it doesn't have much impact. We have a lot of our debt's relatively long-term. We don't have to refinance very much in the short run, but it does actually start to weigh quite heavily. Now, if we start from a lower level of debt, that impact will be less. And of course, interest rates actually aren't the major shock. If you look on the right-hand side, the kinds of things that could knock the public finances off track, really probably more likely to come from growth or from various unknowns that might hit the economy. And in this context, if we start from a lower debt level, we will be much better able to weather these future shocks. So we should really be making the most of low interest rates and the excess corporation tax receipts to get to a more prudent place. Turning to the medium term, the government needs to improve planning for the medium term. We know there are these very big challenges coming from aging and pension costs, from climate change and climate transition, and needing to reduce the over-reliance on corporation tax. The chart on the right shows the increase in spending as a share of national income that we can expect in various categories. Aging is a very significant part of that. Excess corporation tax receipts is a big part of that. But the climate aspects together, they all add together to very strong pressures on the public finances on the spending side. The government really needs to start planning for this more seriously. Of course, we know there's a range of other pressures, including around defence spending, around housing, and the implementation of stauncher care. On the pension side, the government announced that it was going to maintain the retirement age at 66. This is going to add to future costs and pressures. This chart on the right that we've looked at, that we've shown before, shows the PRSI increases in today's terms for workers based on proposed pension plans. For a worker on a typical wage around 35,000 euros, this would raise somewhere between an additional annual PRSI contributions of somewhere between 1,200 and 2,000 additional euros a year. The dark bar shows the part that's represented by the fact there are more people going to be reaching pension age as the baby boomers retire. You can see that not raising the pension age does add fairly significantly to that, particularly in the later years. And of course, given that you're kind of stuck paying for the fact there are more people, it's important to remember this pension amount is coming on top of an already fairly sizable increase. The government should be transparent about these costs. When they set out the plan to not raise the retirement age, they said they would provide the costing for it in April. That obviously makes it very difficult for people to evaluate the costs and benefits of what's proposed. And short-term fluctuations in the social insurance fund, something that some people have commented on, does not justify inaction. These variations are pretty small in underlying terms compared to the overall cost of rising pensions. On the climate side, the government has set out sectoral climate targets. This is an important step forward, but as the chart on the left shows, if you add together the different sectoral components, you fall short of the overall goal. Perhaps more importantly, detail is lacking on how these targets are actually going to be achieved. And the fiscal implications of doing that could be very large, but we still don't know what they are. They haven't been spelt out. We know the investment needs might be around 2 or 3% of national income. This might, of course, be part of that of what's already in the NDP, but all that needs to be cleared up. We also know that, for example, the loss of fuel taxes, they might be up to 3% of national income. So there are really major questions about spending and taxation here for the medium term. On the corporation side, the use of the National Reserve Fund for excess corporation tax is welcome. We see on the left that the government has made an allocation this year, plans to make additional allocations in the years to come. This will play an important role in it not increasing exposure to excess corporation tax receipts alongside things like the 5% spending rule. But there's a number of things about the way the fund works that could be improved. We have a box on this in the Fiscal Assessment Report. One thing, for example, is the current cap of 8 billion could be reached very quickly if corporation tax continues to come in as it has in the previous years. And a weakness of the current design is that it doesn't reduce the existing exposure to excess corporation tax receipts. To do that, the fund would have to be redesigned, rethought, and some spending would essentially have to be allocated to building up real reserves, for example, to pay for future pensions. And this is something that should be given much more active consideration, given both the future pension costs that we have, but also the amounts that are coming in terms of excess corporation tax. In this context, it's very important that options to raise taxes over time should be explored. The Commission on Taxation and Welfare that reported in September made a very useful independent assessment of revenue-raising options. As you may know, last week the Council put out an analytical note by Eddie Casey on the potential impact of the changes that the Commission was looking at. Under our scenario, and there are a lot of assumptions here, we reckon that those measures could raise around an additional 5% of national income through base broadening measures. That's bringing more things into the tax base and eliminating preferential treatment of some things under the tax system. That would take us from being a relatively low tax country today, somewhere like the UK, more to the European average, somewhere between Germany and Spain. Of that, a substantial part would come from property taxes, but it's actually quite a broad-based package that includes taxes on capital wealth, reductions of preferential treatment of VAT, environmental taxes, and some measures on income taxes. It'd be very important for the government to quantify these really rigorously. There's a lot of information that's missing, a lot of assumptions we had to make. So I think it is important for the government to quantify it properly so we can really see what the implications might be. The other thing is the government should introduce a more effective spending review process, as well as looking at taxes. Looking at spending review, they do spending reviews, that produces a lot of useful work, but essentially doesn't engage with the issue of where the government could really be saving money, whether there are things they should be doing more efficiently, whether there are things they shouldn't be doing at all. And that would really balance the work that we see from the Commission on Taxation and Welfare. Strengthening budgeting would also help in terms of sustainability and addressing these long-term challenges. So we've discussed forecasting 5 years ahead, at least, as the foundation for any attempt to understand the pressures that we're facing in the medium to long-term fiscal sustainability issues. The 5% spending rule has been playing a very helpful role, actually, in guiding the government through the energy crisis, the cost of living crisis, but it should be reinforced. It should recognise potentially offsetting impact of tax measures. It should be underpinned in legislation. It should be widened not just to cover the exchequer, but all of government spending in the general government, and it should be linked to a target for debt. The government should also, as it's required to with the budget, publish medium-term departmental spending ceilings. That is, it would take the 5% spending amount from the spending rule and show how that was going to be allocated across different departments. That would help to provide greater certainty to departments, but also for people to understand how the government was planning to manage the public finances in the medium term. This more medium-term focused approach is actually very consistent with proposed revisions to the EU economic governance, and there's a box in the Fiscal Assessment Report that discusses that in great detail. So let me finally summarise the key messages. Ireland's economic growth has slowed considerably. It will remain weak in the time ahead, and risks are high. The government forecasts a deficit of around 3% this year when you exclude excess corporation tax receipts. Budget 2023 introduced a large package of around 11 billion of measures, including both temporary and permanent measures. The Council's assessment is this strikes an appropriate balance between protecting vulnerable households and avoiding inflation. Over the medium term, if the government sticks to its rules, the budget would be in surplus and the debt ratio would fall. But to achieve that will require difficult choices, particularly given ageing and climate costs, together with the need to reduce reliance on corporation tax. The government therefore needs to improve planning for the long term. The fiscal framework should be strengthened, and while the restoration of the National Reserve Fund is welcome, it needs to be developed further to contribute to really managing excess corporation tax receipts in the best way. Thanks very much for your attention. I look forward to your questions.